Good morning, everyone. Tim Nyland here. Today is Veterans Day 2020. Special shout out to all the current and former veterans. We thank you for your service and your sacrifice. Today, we're going to have a look at the broader markets and dive into this concept of the value rotation that was triggered by, at least the start of what everyone is saying was triggered by this Pfizer vaccine results that were released first thing Monday morning. And I think the bigger news is what it really did to the credit markets in the move in the 10-year. And we're going to look at yield curve implications here. But the idea is it shouldn't shock us that much, although a lot of the models are probably changing because I think we were talking about a 50 to 60% efficacy rate of the vaccine, and now it looks like Pfizer's saying around 90%. So that certainly is a game changer for us, but we're going to put our strategist hats on here and lift the hood and take a look at what's actually gone on already and what's already being priced in, and before we really draw any conclusions. If we look at the S&P 500, you'll see the depth of this trough that we're currently working through in earnings. And you'll also note that it's at this point here that value investors always tend to get excited. The growth investors will obviously become more excited once we actually get on this trajectory of growth. But right now, it's all about value, and that's what we're seeing this week. So what I wanted to remind everyone of is what we have done with the earnings certain portfolio, okay? In a sense, removed all of that earnings variability. And it's the same for the core 75 that I have on the screen. In other words, we were never subject to that earnings variability. If we look at the Admiral, you'll see the exact same thing. We actually have an increase in earnings. In other words, these companies did very well. Same thing with the dividend aristocrats. So we go from the core 75 to the 30 stock Admiral to the 25 stock dividend aristocrats. And you'll see that in the end, do we really care about trying to time the market for growth or value? And the answer is no. Obviously, not the same when you are benchmarked to the S&P 500. It's really all about this value rotation that we're experiencing right now. So I wanted to also bring the tilt portfolio into the perspective as well, because you'll see that trajectory looks very similar, and we've just got spectacular forecast growth, 17%, 23%, and 26%. So if you've been watching the news, you've been watching CNBC, reading the journal over the last couple of days, everybody's trying to convince you that now is the time to basically unload all your growth stocks and start rotating into cyclical. So we're going to explore this a little bit more. And the first thing we're going to do is we're just going to break apart the tilt sector stocks very quickly and just talk a little bit about what the COVID vaccine might mean for Apple. Seems as though Apple's been under pressure as of late. And the idea that Apple is going to suffer under widespread vaccination for COVID is absolutely insane, in my opinion. Apple's had to close up retail stores. And I think that when we start talking about widespread vaccination against COVID and the post-COVID era, this environment is going to certainly boost the prospects for sales of new iPhones, and we're going to see that Apple ecosystem flourish even more. The same thing can be said for any of the other stocks. Adobe. If you look, I want everybody to pay attention to the price and earnings trend, right? So these companies let us in with solid growth prior to COVID. They provided solid growth for us through COVID, and they're going to provide solid growth, or at least they're expected to provide solid growth for us post-COVID. And if you look at Adobe Systems, they've got 3 verticals, all of which are absolutely on fire. Next stock in the tilts. And I'm driving this home because it's important that everybody see the relationship to price and earnings and these growth trajectories to understand why we like growth still in this environment relative to what's going on in value. So if we look at Amazon, you'll see that we still have well in excess on average of 40% growth. And Amazon is still expected to be a huge winner into this concept of continued acceleration of online shopping. So this concept of online shopping, especially this holiday season, as we're heading into what is expected to be record-breaking COVID outbreak, Amazon's just going to benefit even more. And related to that as well, the AWS, including Google Cloud, Microsoft Cloud, these systems are all going to experience continued adoption. So the other thing that's going to help Amazon with COVID vaccinations is that if you take a look at guidance, Amazon is actually expected to spend $4 billion for COVID-related measures in the December quarter alone. So that's this upcoming quarter. So once COVID is behind us, it's definitely going to help Amazon's and others' margins as well. Same thing can be said for Facebook. Once we get businesses back off the ground, it's just going to do nothing but help Facebook advertising, including entertainment, leisure, media, you name it. We're still looking at solid growth if you look at the trajectory of this forecast earnings. Again, we're driving this home for a reason, because we're going to focus on value here in just a minute. You can see Google here. Google search, adoption of Chromebooks, highest ever, 21% solid growth trajectory expected to continue. So the idea here over the last couple of days with everybody bailing out of tech stocks is you know, and diving into value stocks, that's fine. I think it's probably best to term it more as a valuation catch-up for those names that haven't had a chance to participate, rather than try to coin it as a rotation. And I've heard many portfolio managers say that this is a rotation that's going to go on for years, and I strongly disagree with that. I think that both value and growth will participate. If you remember back to our prior strategy calls, the top 5 holdings in the S&P 500 represent somewhere in the neighborhood of 23 to 25% of the S&P 500, and they're largely tech. Okay, so this concept of these strategists and these PMs saying that value is going to rotate, tech is going nowhere over the next couple of years, are also the ones that have S&P forecasts of 4,000 or 4,200 or even 4,500 here over the next 12 to 18 months on the S&P 500. My message is that even with a COVID vaccine, right, we're not going to get there without tech. Tech is just that important. So the idea is we need to explore this value rotation, and we need to actually look at why this market timing is actually dangerous, right? Because the idea is we're still not out of the woods here yet. So interest rates are starting to normalize during this recovery. If I put a company like Facebook up on the screen, any of these companies that have had a correction this week, they pretty much all have. And we look at this 30-10 Treasury spread, and again, I'm in the institutional platform, the Zacks Research System itself. And up here, I've actually got a 1-year chart. Just do a right mouse click and show you that. And you can see what happened here. And this is back on, obviously, 11.5. We had this really rapid rise to the tune of about 20 basis points in the 10. And it actually drove the 30 up. And this is what I was talking about in terms of confirming trend with regard to hopping in the bank stocks. We need to see a lot more than this. This is no more than what we actually saw back in October as well in terms of interest rates rising. I know that everybody's saying that we expect interest rates to rise. And on the back of this latest COVID vaccine news, we expect interest rates to perhaps rise rapidly. But we got to remember that the Federal Reserve is on the sidelines. Yes, the credit markets can do the job of the Fed, especially on the long end of the curve, but we need to keep in mind how much debt has been taken on some of these balance sheets. And the Fed is obviously aware of this, and we can't afford to have rates go up too quick. But you can see what happened to the forward multiples here on stocks like Facebook. And I could throw the tilt portfolio up here, and you'd see the exact same thing as these rates rise. I think it was more the actual speed of the rate increase that was more of the shocker than anything else. Okay. So what I've done is I have split value into 4 buckets. and I think that you guys are really going to enjoy this. We're going to look at banks. We're going to look at leisure stocks. We're going to look at airlines. And then we're going to end with probably the biggest shocker of them all, which is the cyclical and industrials. And I touched on Caterpillar and Deere in my last conference call. And we're going to expand upon that. I actually put together a composite of a group of the top cyclical industrial names here in the US. And so we're going to take a look at that group in aggregate. Again, more of a strategy call than anything here. So let's go ahead and roll the tape back and go to our price and earnings chart. And let's take a look at the major money center banks. And what I'm going to do is I'm actually going to use the Zacks sector and industry composites. And to get access to these, you can just click on the magnifying glass. I've actually written down the ticker symbols themselves, but you can go into Zacks composites by category. And for our purposes, we're going to be in this section here, major banks and major banks regional. Actually, we're going to be in major banks and thrifts, because under banks and thrifts are where all the regional banks are. We actually split them out at the sub-industry level. So this is where we're going to focus here, and then we're going to end up in leisure services, going through these recreation, gaming, hotel, motel. So I've written these ticker symbols down, so we don't need to click on them, and we'll go ahead and start. And the first one that we're going to take a look at is the major banks. And the reason why we started this webinar out by showing the earnings certain portfolios and the Tilt portfolio along with each of the individual members within Tilt is you'll see that the bank scenario that everybody is getting excited about and telling you to shift a large portion of your portfolio to doesn't look anything like the strategy that we have employed with earnings certainty. As a matter of fact, the major bank sector itself, or major bank industry, if you will, really hasn't performed well at all over the past, let's say, 10 years. And you can see what's going on here. We've got a buy side that's pretty much just trying to keep valuations in line with where earnings are going to be. And yes, if we get a steepening of the yield curve, it will help. But we've got a lot of structural issues in the banks right now, specifically tied to that yield curve. Nothing is guaranteed that rates are actually going to rise as fast as everybody is expecting. So I don't think I need to dive into the issue with major banks much further. All you have to do is look at the price and earnings in this chart, and you will see what everyone is chasing. They are literally chasing wherever this earnings line is going to go. It gets a little bit better when we talk about the regional banks, which is why I've let everyone know in the past this is probably more my favorite group. And you'll see that it's a little bit growthier orientated. But you can also see that along with that growth, we've pretty much made a bid to fair valuation almost overnight in this latest round of news that we've received. And again, if we're going to go looking for value in the value patch, we're going to have to be pretty selective, because if you look at this point back here at the end of 2018 relative to earnings, you can see that we're actually, from a pricing perspective, even higher than that. So you could almost say that we've pretty well baked in earnings all the way out to the end of 2022. So the idea is to get much more out of the regionals in aggregate, we would need a yield curve steepening faster and spreads widening at a faster rate than what is currently being priced in by the sell side, which is where these estimates are coming from. Okay, so we need to proceed with caution here. I have specific names if anyone wants to get some exposure into the regional banks. I said them last week. I've actually added probably 2 this week. My favorites in this space are US Bank, ticker USB, Regions Financial, ticker RF, Silicon Valley Bank Corp, which is SIVB, Fifth Third Bank, ticker FITB, Bank OZK, this is the old Bank of the Ozarks, ticker is OZK, Ally Financial, no brick and mortar presence, I like this one, ALLY, and then One Main Holdings, OMF. Okay. So the idea here is that the other reason why I'm just not a huge fan of banks, I want to remind everyone of, is when we take a look at these names relative to the returns that you can get elsewhere. Again, whenever we're looking at allocating assets, we need to look at our alternatives. Just because the S&P 500 has a certain percentage of their weight allocated to banks doesn't mean that we have to. The best way to take a look at the efficiency of banks relative to a completely different group, sector, industry is to look at return on assets. And if we take a look at the major banks' ability to generate return on their assets, keep in mind that when we look at assets, right, within assets, we are able to incorporate not only the deposits and what the banks are able to make on the deposits, but we're also able to incorporate the capital structure and everything else related to the bank. So we can actually do an apples to apples comparison of the bank group. In this case, these are your regional money center banks. This is where your JP Morgan, Bank of America lie. And we're sitting at 0.44, or you can maintain your earnings certain tilt exposure. Again, these are our 6 stocks that on average have probably 28 times the return on assets that you're going to get out of that group of regional money center banks, not the regionals. We will switch this to the regionals now, and you can see that it gets a little bit better. You're at 0.8. So do the math. We're somewhere in the neighborhood of maybe 17, 18 times more efficient with the earning certain tilts portfolio. Okay. So keep that in mind as another reason why I'm just not a huge fan of trying to time the banks. Okay. When we start looking at leisure stocks, okay, we are going to start out by looking at leisure services. Whoops, wrong symbol, ZI9M. And I don't want to give this away, so let me go back up to price and earnings. And you can see where the problem is, obviously, here with leisure services. We really can't even look at a PE F12M on this chart because we're still forecast to be in recovery. And even at the end of 2022, we are still well below where we were pre-COVID at the end of 2019. And yet prices in the leisure services composite market weighted are almost back to where we were at the end of 2019, 2018, which is a little scary, right? So we've priced in a huge rebound in this group, and it's pretty much happened overnight. Since we got the news from Pfizer, this has been a really rapid increase in this group. And again, this includes recreation services, gaming, hotels, motels. And I want to warn everyone up front that this is a completely different group of stocks now. The capital structure in this group has changed. If you look at total debt to total cap, and you look at this relative to the S&P 500, you can see that they have taken on a tremendous amount of debt. Debt loads that this group has really never seen. Not even in the 08-09 financial crisis have they seen this. Okay, so this group is completely changed. And if you want to see the group that has changed the most, it would probably be the hotel motel. This will send chills down your spine. I still like Marriott. I still like some of these names, but wow. When you take a look at what's happened to the debt load, and a lot of this is structural, they've been making a lot of investments in the business, but obviously a lot of this is now COVID related. And it's just getting pretty lofty relative to the broader market. And again, if you're looking to build portfolios that have really healthy balance sheets, when you look at what we have going on with our tilts, this is a completely different story. Okay, here's the tilt portfolio at 26. If you're taking on the average hotel motel stock, you're at 96. So a totally different story. Okay. So what do these sub industries look like? Let's take a look. So here's hotel motels, right? We've got a really nice solid rebound underway, but again, we've got just this massive trough that's pretty well unprecedented. And the interesting thing is, from a pricing perspective, forget about all the debt they've taken on. We're all the way back here to 28, early 2019 pricing with earnings back here, and we're not even expected to get to that level of earnings until 2023. So my question is, how much of this is already priced in? And this is why I'm skeptical as a whole of this particular group. So if we look at recreation services, does the picture get any better? And the answer is no, it actually gets worse. Now we're looking at a recovery in 2022 that's still nowhere near where we were pre-COVID, and we've got pricing all the way back, to 2013 levels, 2012 levels. So we've got some real structural issues in this marketplace. Now, can it rebound quickly? Of course, but we need to really be aware of where we're at with these industries before we invest in them. Gaming looks to rebound a little bit quicker. And but again, we've already priced in that rebound almost fully. You can see that from a pricing perspective, we're right back to where we were at the end of 2018. We came up, we came down, we're right back, and earnings are nowhere to be seen. So again, even in the gaming sector, we've had this rapid increase ever since the bottom of COVID. That's the real message here. We've been really rebounding this value play. These industries have been rebounding since the March lows. Okay, so this is nothing really new. Okay, so if we're going to invest in leisure services and we're going to partake in this rotation, we're going to need to be really, really careful. That debt to capital ratio, we're going to really need to pay attention to, because we know that times have changed. Okay, next thing I want to do is talk about the third bucket, which is the airlines. And we have a sub-industry for airlines that are non-freight. So this is going to be all your commercial carriers, passenger airlines. I'm just going to throw the code in. And I think that, you'll see the problem here right away. Obviously, we've got a really nice rebound that's taken place in the airlines sub-industry. This is where obviously American, Delta, Southwest, everybody resides. And we don't really know when this air travel is going to come back. Now, if everybody's able to get vaccinated, everybody accepts the vaccine, everybody does it. We know it's 90% effective. At least we think it's 90% effective. We don't know how long it's going to last. We know it takes 28 days for it to take hold. There's a lot of unknowns here. And this is currently the sell side forecast for this rebound. Now, I'm sure that a lot of revisions are going to come in. Again, 90% efficacy changes all the sell side models, perhaps. We'll have to wait and see. But we've got one heck of a recovery, perhaps already priced in, and this pricing in started at the March lows. We've been slowly recovering ever since. Okay. The real thing that scares me about this particular sub-industry is the amount of debt that they've had to take on to sustain this COVID era. We're back to higher debt levels now than we were back during the financial crisis. Okay. So we were just now getting down to a point where, look at how long it took us to pay off all the debt from the financial crisis, and now we're actually even higher than that. It's a little scary. So when you're looking at the airlines, right, look at the balance sheets. These are not the same companies that we were dealing with pre-COVID, and you've got to be aware of that. Okay. Next thing I want to focus on are the cyclical industrials. And for this one, I created a composite, and we'll break this into its members here in just a moment. But this is where everybody's pounding the table saying, we need to rotate, we need to rotate. They're doing it now. And I'm sorry, but the rotation actually started in March. And probably the most interesting thing is this leg up that we've had pretty much this week. Boy, this whole what we're calling a rotation since Monday still leaves me scratching my head, because if you look at the tea leaves and you look at what I discussed last week in terms of what's gone on with U.S. production, specifically these key ISM numbers, you'll see that we actually broke out. Remember that anything below 50 is contraction. And in May, we were at 43.10. In June, we hit 52.60. That's expansionary. So June 30th, we broke out in expansion. Okay. That would tend to, whoops, let me grab the price and earnings chart. That would tend to tell me that that would probably be the start of the cyclical rotation. So if I came back here to 630, you can see right here is where ISM became expansionary again. And I told everyone last week how important this number is. I'm going to tell you again that this is probably one of the best numbers out there in terms of U.S. aggregate manufacturing index here in the United States. This is going to be the index that is going to give us the pulse of what's going on in terms of U.S. manufacturing. The Federal Reserve watches it, and obviously the buy side watches it. You can read these moves almost one for one every time this happens. Keep an eye on it, right? Because look at what happened to this group of industrial cyclical conglomerates when we moved from contraction to expansion. They took off in terms of price, and they haven't looked back. Okay. Now, the thing that scares me here is that we've got a massive, massive PE multiple built up in these names. I mean, just look at how the price has just run away from earnings. We're still working through the trough, and we've literally priced in perfection in terms of this group as an aggregate. As a matter of fact, if I go to my next screen, which is the PEF12M, you'll see that we are now actually above the median over the last, let's say, 20 years. We're sitting at a 0.52, and I've actually got this relative to the tilts. Let me put this relative to the SP5. And you can see that we're still above median. We're 102, median's 0.96. So we've already priced in more or less, let's just call it median valuation over this time frame. And it's a little bit scary, right? So everybody is now making the call that we need to rotate into cyclicals. And my point is that cyclicals, along with tech, along with regional banks, this story is not new, okay? There hasn't been a rotation because all ships and all boats have actually risen together. I mean, this group of industrial conglomerates rose right along with Google, right along with Apple, right along with everyone else, perhaps not as fast relative to earnings. But now we've gotten to a point where the PEs in this group are also getting extended. And I brought that to everyone's attention relative to growth last week in Caterpillar and Deere. And so if you split this group of cyclical industrial companies into its members, you'll see, right? I've got Caterpillar, Crane, Carlisle, Deere, Federal Signal. You can just kind of bump through these. General Electric, Honeywell, Ingersoll Rand, 3M, Raven Industries. As a group, these things have perhaps gotten a little bit ahead of themselves. There are select individual names in here that are worth a look, but again, we need to be very, very selective. And I want to end with the importance here that we do have a long way to go until we're out of this COVID era. None of this is for certain, and we need to proceed with caution. And I urge everyone to avoid the temptation of these knee-jerk reactions. We need to stay disciplined, and we just need to be careful. because these things can reverse course just as quickly as they take hold. And that is the reason why I'm such a fan of just consistent, stable, solid growth that we have with not only the earnings certain, but the earnings certain Admiral, the dividend aristocrat, as well as the tilts that we're recommending. The tilt portfolio, this growth is not going to subside just because we have a coronavirus vaccine. Okay. These companies, again, brought us into COVID. They got us through COVID, and they're going to deliver post-COVID. So I want to leave everyone with those thoughts. And again, follow me on Twitter, on LinkedIn, and please reach out to me. Email your support rep if you've got any questions. More than happy to speak with anyone about this. Thank you.